What is variable overhead analysis? Well, generally overhead are the costs that are not directly attributable to the production of a product. It's the other things that make it possible to actually carry out the production of that product. These are production costs that uh, they're generally, once again, difficult to attribute to a product itself. You have to simply distribute them over all the processes that take place in the organization. Now, a variant of that is the variable overhead cost. So a variable overhead analysis focuses on these costs. So you look for the production costs that somehow vary with the level of production output. Like I said, this is very strange for overhead, but there are scenarios where overhead will vary based upon the production output. Now, why do you need to know this? Well, there are several reasons. One, you always want to identify the cheapest or the most low-cost method of producing a quality product or a product that meets the quality standards that you desire. Identifying variable overheads is one of those cost factors that has to be included in that consideration for decision-making purposes. And if you're going to project and create budgets based upon your projections about future costs or expenditures, you're going to need to know this. So what are some examples of variable overhead costs that that again change based upon the level of production? Well, production supplies, things that are tangential to the actual production of the product, but are necessarily used as part of the production process. That could be anything from bathroom or janitorial supplies, right? Equipment, utilities, anything that you're using as a byproduct, that type of thing. For example, if you were running the heater in the building just so you could be present to actually produce the product in times when otherwise you wouldn't be in the building running the heating or air conditioning, that incurs a power bill, additional cost associated with it. That would be a variable cost. Materials handling, this is hour wages or something like that of individuals handling materials such as storage costs or something like that, that perhaps would dissipate. You would have to rent less space or incur less time overseeing materials if you produced more. So again, that would be a variable cost there. So what are some matrices that go, some metrics that apply to variable overhead analysis? Well, one is the efficiency variance. And what this is the actual hours required, once again, to produce a product, the actual hours of overhead versus the budgeted hours. And then you'd multiply this by a standard overhead rate to see what the efficiency variance is there for that type of overhead that you've identified. And another metric would be your spending variance. Okay, so if your efficiency variance is based upon actual versus budgeted hours put into the process, or the hours that would of overhead, say you're measuring labor hours or machine hours. Spending variance relates to your budget. So what have you actually budgeted there versus what is your actual budget spend? Okay, on overhead items. This would be, again, a spending variance. So these are the two primary metrics you're going to track with regard to a variable overhead analysis.